So it's the middle of May 2023. I'm here with Glenn Henry from Loan Depot, our trusted loan advisor, and want to talk about some of the pain points that buyers are feeling in the marketplace. So what is number one pain point that you're seeing buyers feel?
Yeah, there's a couple of them, right?
Yeah.
But one of the big ones is inventory. So there's not a lot of homes for our buyers to be choosing from today.
And let's table that. I'll talk about that. What's the other elephant in the room?
The big elephant is interest rates,
Okay.
right? There's a real affordability issue.
Yeah.
Rates are up
Yeah.
and it's tough to qualify. And if it's not qualifying, it's that it's just tough for our buyers to be able to swallow what that payment looks like.
Right, and so the affordability factor is keeping a lot of buyers on the sideline. However, is that when we see homes go onto the market, we are seeing demand there. So from the beginning of the year till where we're at currently, how are you guys seeing new applications come in?
We are seeing an increase. There's a lot of buyers. We're seeing an increase in the number of applications that are out there, and getting our buyers approved and ready to go. I mean, that's an important piece of this. And we're getting that done, and they're out there looking for homes.
So from the time that an application comes through and you pre-qualify a buyer, about how long do you think it takes before they transact?
So yeah, that depends on how realistic they are in this market, right?
Right.
So there's a little education with you, guiding them through that process, with us guiding them through that process. But probably 2 to 3 months is we can see them getting into a property.
And where have rates been over the last 2 or 3 months?
Yeah, we're on that roller coaster. We see them going up, we see them come down. Right now we're on this little upward trend. So it's really daily, and we really have to look at what rates are doing every single day.
Where do all the economists forecast those rates being in 8, 12, 24 months?
I think definitely it's going to be less than where we are now.
Okay.
So any loans that we're doing for our buyers right now, this is just a stepping stone. This is just, let's get into the property. We can refinance this loan at a later time and get you into that more affordable payment, more of a long-term loan.
I know at the beginning of the year, a lot of people were talking about rate buy downs. Out of 10 loans, how many people are participating in a rate buy down?
1.
Okay.
Yeah, it's really low right now because we're seeing the appetite for the seller. The seller's not really willing to do that because they've got many other buyers that might not be asking for that. We, from the lending side, we're not really encouraging our buyers to do that rate buy down, because if they're spending their money, then we want to make sure that they're using those funds and they're getting the most out of that money. So sometimes it is a payment though, and we need to get that payment down for that temporary window. So we are seeing it.
So kind of what I'm hearing and feeling is that the economists are thinking that rates will decrease. The consumers are also betting on that by not doing a rate buy down, keeping their liquidity in their bank and just maybe paying a little bit higher monthly payment, but forecasting that those will go down. I saw an article about a week ago about more consumer debt. I mean, did you happen to see that same article?
I've seen that.
So obviously when you guys are doing debt to income and you guys are qualifying people for financing, you're seeing that. Are you guys starting to see more debt for consumers?
Right. One of the big things for us is we see that buyers are incurring more and more debt. They're increasing their credit card debts, and then that's actually lowering their credit scores, right? So now when the credit scores are going down, now the rate's going up. So it's really this balancing act of, hey, instead of putting all this money down on the property, maybe let's look at, hey, how can we pay down some debt? Maybe how can we increase the scores? Maybe how can we lower that monthly payment? And that just helps with that affordability issue.
Right, and doing this for decades, I know that we were talking offline, but you're saying you are surprised at how many people will carry such a high credit card debt, but then when interest rates on a fixed appreciating asset is 6.5%, will balk at that.
Every time.
Yeah.
And yet we're paying 15-20% on our credit cards. And a lot of consumers don't even know what they're paying on their credit cards. And I think that's just an education piece for all of us.
Definitely. On the inventory side, in Southern California, in the Orange County marketplace, usually we'll have about 7,000 homes at this time of year. And right now we're around 2,000 homes. So what you're seeing is the same thing that I'm feeling, is that we're working with buyers that have limited options on what to choose from. Demand is fierce, pricing is stable or even moderately increasing. And then of course, affordability with 6.5% interest rates takes some properties that buyers could afford last year or the year before completely off the table. So what we see is about 70% of homeowners have rates that are under 4%. Is that about
That's
2/3?
good.
Yeah. So there's not a lot of want or need for sellers to want to move and put their home on the market. What would you say if interest rates this time next year to be 1% lower? So let's say we're in the mid 5s.
Yeah, I know for us personally, we have a lot of clients that we have them pre-approved, they're ready to go. We've been through underwriting, and now they've kind of pulled back and they're sitting on the sidelines waiting for rates to go down. So I think that a lot of lenders have that, right? So we see interest rates come down, we're going to see a lot of these buyers get off the fence and they're going to get back into the marketplace. So now there's more competition.
And you said something about rates to go down. Have you polled or talked to any buyers about what they would think rates would go down where they would start to participate in the market?
Yeah, that's something that we've just started doing recently is like, hey, you know, we want to see rates go down, but okay, what is that rate? At what point does it make sense for you? You know, we've got sellers out there that are thinking of selling and they're getting maybe sized out of their home and they've got a 3.5% interest rate and they don't want to get into a 6.5% market. I get it, but they're also getting forced out of the size of their home, right? So at some point they need to do something. So, you know, I think a 1% reduction in rate would do wonders for us.
Yeah. Do you think that you're going to see more of refinancing happen if interest rates were to go into that 5.5%?
Yeah, for sure. We're seeing a little bit of refinancing right now, but it's all cash out refinance. So talking about the debt that you were just talking about, it's like, hey, let's look at this and let's figure out what are we paying on our credit cards right now? How much money is going out on our credit cards at this high interest rate? And let's refinance that. Let's pull some equity out because owners have a lot of equity in their property. So take that equity, let's pay off some debt, and then that starts to free them up. So a lot of cash out, or not a lot, but some cash out refinances today. If we were to see rates go down even 0.5%, I think that there's a lot of buyers out there that could benefit from that, even a 0.5% interest rate reduction.
So refinances should be on the rise, possibly later this year into next year. Whereas at the beginning of the year, the refinances was like, what is a refinance, right? Nobody
exactly.
As far as homeowners are refinancing properties, pulling cash out to pay off higher debt or to do improvements on the property, and stomaching the 6.5% interest rate, and let's say that they're not investing that money back into the property, but they're paying off other debts. Is that still beneficial for them to have that higher interest rate with the payment than to pay the higher credit card?
Yeah, you say still making that higher interest rate, but the reality of it is we all look at this from a payment standpoint, like where are we comfortable with a payment? From 2021 to 2022 and now into 2023, the percentages are going up of homeowners that, or just not even homeowners, just people in general, that they're putting more and more money on their credit cards and then their savings is going down. So if you were to take that and say, okay, well, let's do a cash out refinance now and let's pay off some debt. Well, if my expenses today are $8,000, but I refinance you at a higher interest rate on your mortgage and I pay off your debt and now your outgoing expenses are $6,000.
Saving $2,000.
That makes sense, right? So now we save $2,000. Now let's take that $2,000 savings or $1,500 of it and now let's throw that at the mortgage.
Okay, so you're paying it down.
Yeah, so now let's continue to pay it down. Let's be aggressive with it. We're spending less money every month. And we're paying off debt. So you're making minimum payments on those credit cards. You're never going to pay them off.
So let's transition into where the housing market's at today, where we think it's going to be at in the next 6 months, 12 months, 24 months. A lot of this is speculation, but I think that some of the things that we're seeing on the internet, is that a lot of these taglines that home prices are going to fall, decrease in sales. So definitely from a real estate standpoint, we see about 23% of less transactions than we have year over year. But like you spoke about, that's because interest rates are higher, so less sellers are coming to the market, thus there'll be less buyers. I think that we're gonna end up somewhere between 4.5 million sales nationally, where years before we've been somewhere around 6 million. So I think that will be impactful. But I also think that in some areas like Orange County, we're a little bit in an insulated bubble. We're not building a ton of homes. And so prices are very protected based on demand and then based on the amount of inventory that comes to the market. So where do you see the housing market as far as if you had to say pricing in the next 6 to 12 months?
Yeah, I think pricing remains stable or continues to go up. I think it actually goes up because if you look at the household formations for 2023, I think it's 1.9 million new house formations. That doesn't have to mean someone's buying a home. That means someone is graduating college, maybe they're moving out of their parents' home and they're going to rent a property. There's 1.9 million new household formations. And from the building standpoint, there's 1.4 million new homes being built. And they figure 100,000 of those are getting built just because of age. They needed to be torn down and rebuilt, or fire, or a tornado, or whatever other.
So they're not going to the market, they're just being rebuilt.
Yeah, so 100,000. So that's really, you got 1.9 million new household formations and you've got 1.3 million new homes being built.
Right.
That's a supply and demand issue, right? So value should continue to go up.
And we also spoke about the amount of equity that current homeowners have in their property. So I think that if a homeowner needed to move based on either, let's say, job relocation, or for some reason there was a job elimination and they needed to tap that equity, they could sell the home at a standard sale and not take a price decrease. They'd sell it at fair market value just because the demand is high and inventory is low. So I don't see a transition in pricing or any type of short sales or foreclosures happening in the market. Do you agree with that?
Agree, 100%. Yeah.
So if you were to say, why is all these internet bloggers or people that are out there or YouTubers like housing crash forecast in the next 90 days or whatever, why is that?
Well, I think there's multiple reasons, but I think one of the big ones is they don't know the numbers.
Right.
And I think there's also like, hey, if you read that, if you're not a home buyer and you're not in this industry like we are, and you read that, you're going to click on it, right?
Right.
Like you want to know, like, hey, I want to buy a house. I want to click on that. You're going to read it. Well, that's not really what's really happening.
Right.
So.
Yeah. So one of the things that we're seeing on the real estate side is that there's about 1.6 licensed agents in the United States. And if you look back just 10 or 11 years, there was 1 million agents. So we're going to have the same amount of transactions as we did in 2012, 4.4 million. And there's going to be done with about 1.6 million licensed agents. Now, in our business, 80% of the volume is done by 20% of the agents. And so the reason I would give you that intro is I want to hear about on the lending side, especially with everything that we're hearing in banking. What's going on in the lending? Is there consolidation?
Yeah, we're seeing a huge consolidation, just like what you're talking about it. And we have that 80-20 rule too.
Yeah.
It's like, lenders that are withstanding this market right now, this is our careers. And when you see interest rates come down, you see a lot of lenders getting out of the business right now. We'll go into Starbucks and they're our barista, right?
Right.
But when rates come down, they'll jump back in the market. So you've got a lot of lenders that they just bounce back and forth, and that's kind of just something that they do. They're in that refinance market and they're there. So when you're looking at purchasing a home and you're using a lender that has been in the business for a long time, we are, like I said, this is our career and we're here for the long haul. So we'll get through these times.
And I think that a lot of the loan products that are out there, I know that a lot of loan products, they're super solid, right? Like where they were in 2008 is a completely different market than where they're at now. But the longevity of what it is that you do, and one of the things I love about Loan Depot is the free refinance after 12 months. Remind me what that.
So our lifetime guarantee. So what that does is after our buyers have and this goes right to the rates today and not buying down the interest rates, is that when you have made 12 payments on your mortgage, you have our lifetime guarantee. And what that does is that pays all of your lender fees for you. So it makes it very advantageous for you to be able to refinance, and we can refinance for even 1/8% in the interest rate, and it can make sense for you.
Right.
So
if you like this video, make sure you subscribe to our channel, and we'll see you on the next video.